One of the ways most people increase their wealth is through investing in stocks. You buy a stock at a low price and you sell it at a higher price. These transactions are considered capital gains, also known as realized gains. On the other hand, if you buy a stock at a price and sell it at a lower price, these transactions are known as capital losses or realized losses. Please make sure you watch the full video to see how you can use capital losses to offset capital gains. It's important to understand all of this because if you're executing a sell order, most likely there are some tax consequences. We're going to go over how capital gain tax works and strategies that will help minimize your capital gains. Before we get started, let me remind you that while I am a tax CPA and over a decade of experience, this is not tax advice and every person's tax situation can vary. Please consult with your CPA. So let's get started with a simple example. You bought a share of Apple earlier this year for $120. Towards the end of the year, the stock went up to $150. At this point, your stock position increased by $30. If you do not sell it, you have an unrealized gain. You do not have to pay taxes because an unrealized gain is not taxable. Regardless of if you hold it through the next year or in 10 years, you will never have to pay taxes on it if you do not sell. However, if you do sell it, you now have a realized gain of $30. The $30 will be taxable, but the taxes will depend on how long you held it and what is your income in that year you sold it. There are two types of capital gains, short-term and long-term gain. If you held the position for a year or less, it is considered a short-term gain. They are usually taxed at the same rate as your ordinary income, which is based on your marginal tax rates. You can subscribe to my channel as I will do an in-depth video on marginal tax rates. Stocks held for over a year are considered a long-term gain. They are usually taxed at a lower tax rate. The tax rate will vary based on your income and will range between 0 to 20% for 2021. Now, we went through a very basic example on one simple transaction. You might be asking, what happens if I have many transactions? Let's go through some examples. You hold 4 shares of different stocks: Apple, Etsy, Microsoft, and Boeing. Over a year ago, you bought Apple for $120 and sold it for $150 at the end of the year. This would be a long-term capital gain of $30 since you held it for over a year. Over a year ago, you also bought Etsy for $200 and sold it at the end of the year for $270. This would be a long-term capital gain of $70 since you also held it for over a year. Earlier this year, you bought Microsoft for $150 and sold it for $350 at the end of the year. Since you held it for under a year, this would be a short-term capital gain of $200. A few years ago, you bought Boeing for $400. The stock is worth $200, but you have not sold it yet. This would be an unrealized long-term loss of $200 because the value went down in value and you have not sold it. To summarize all of this, you have a long-term gain for your Apple and Etsy share and a short-term gain on your Microsoft share. All of the long-term gains are added together, so you will recognize a total of $100 long-term capital gain. All of your short-term gains are added together, so you will have a $200 of short-term gain. The Boeing stock is unrealized, so there's no tax impact. If you have anything you'd like me to cover, please comment below. And also, don't forget to like this video and subscribe to my channel. Now let's go over some strategies to decrease your capital gains. Let's go back to our example of our 4 stocks. We can decrease your gain by utilizing a strategy called tax loss harvesting. Instead of holding onto your Boeing stock, you can sell your Boeing stock for a $200 realized long-term capital loss. Just remember that you cannot rebuy that stock until 30 days before or after the sale. That is called wash sales and the loss will be disallowed. The $200 realized loss will first offset your long-term gain. The remaining will offset your short-term gain. So the $200 realized loss will completely offset your gain in Apple and Etsy. So now you have a 0 long-term capital gains. The remaining $100 realized loss will offset your Microsoft gain of $200. You now have only $100 of short-term capital gain. Now let's go into more details on how you can further decrease your capital gains. Back to the example before, you can decide to defer the sale of your Microsoft share until the first day of next year. That will be a realized gain for next year instead of this year. By doing this, you now have an overall capital loss of $100 that is reported on your tax return instead of a $100 short-term capital gain. In addition, in the next year, you may now recognize long-term capital gain instead of a short-term gain if you held it for over a year. Just remember that long-term gain has beneficial tax rates, so it's better to have long-term gain than short-term gain. Now that we have more knowledge in capital gain and losses, let's close this video with how it all gets reported. There can be many transactions throughout the year, and it can be very hard to keep track of all your positions. The good thing is that the brokerage accounts like Robinhood or E-Trade have documents that you can pull. These brokerages will generate a 1099. This report is sent to the IRS and also to you. It should report all your transactions in that current year. All of the transactions will be reported on your tax return on Form Schedule D and Form 8949. So there we have it. I hope this video is helpful for you. If you like this video, don't forget to like this video and subscribe to my channel.